All these patients complaining they can't get their medicines. Insurers and PBMs are often owned by the same giant company, so middlemen, like me, decide what medicines you can get and how much you pay. But don't worry, if your prescription gets denied, we know another one that works for us. I mean, you.
Washington should stop PBMs and insurers from driving up drug costs. Learn more at phrma.org/insurer costs. Paid for by pharma.
Reality radio for a really great future. We're talking real money.
Hey, thanks for joining us on Talking Real Money. Tom Cock here, special guest in just a moment. But I want to say thank you to all of you who take the time to send us questions, whether those be written or verbalized. We love it. We love the feedback, as long as it's positive. We take your feedback, and we love the questions. So we're glad to help any way we absolutely can. So we're going to take up a bunch of those questions with advisor Roxy Butner in just a moment. But I first want to note something here that it's fascinating to me, and that is this growth of exchange-traded funds, ETFs, not EFTs, which many people still say, I think because F comes right after E, but ETFs. And by the way, this was a question recently on Jeopardy! We mentioned this on the podcast, and all three contestants did not know what an ETF was. An ETF is a basket, right? It holds other securities in it, whether those be stocks or bonds, whatever it is. And they've grown tremendously. In fact, $1.5 trillion added to ETFs in 2025, majority of those in stock funds. Big money, of course, going into gold and silver there, thematics like AI, robotics, infrastructure. The fastest growing exchange-traded fund in 2025, VOO, which is the S&P 500 index. I can live with most of that. The part I can't live with is that 85% of the new exchange-traded funds, of course, everybody's getting in this business because they can see where you're headed. 85% are what they qualify as actively managed. In other words, they have somebody picking stocks or timing markets or picking themes or doing all those kind of things. And some of those include, by the way, Avantis and Dimensional. We get in an argument whether they're passive or active, but we're going to want you to be pretty much passive. Don't want stock pickers. We don't want people predicting. That's bad enough. But the fact that a third of the new exchange-traded funds, a third are either using leverage or a single stock exchange-traded funds. We don't want you to use those kind of things. And a lot of those are used for daily trading, which is something we don't recommend and we don't want you to do either. But to get the most out of exchange-traded funds, remember, you could buy the wrong ETF. Just because it's an ETF doesn't mean it's the right thing to buy. We want you to use index or rules-based funds, exchange-traded funds. We want you to avoid the themes and the sectors and the individual stocks and the leverage and all the rest of the garbage that's coming out on a regular basis. And we really want you to use exchange-traded funds that have an expense ratio, how much they charge you all the time, that are less than 0.25% a year. So we want them to be on the inexpensive side. We don't want them to be speculative. And we want them to be for the long-term use, which is true of all the way we want you to invest. It's just exchange-traded funds. People have this weird thing like, I'm in an ETF now, so I have to be safe, right? Nope, you could be buying the wrong ETF. So a lot of misinformation out there. And I guess the other one is don't go to Instagram for your investing advice, which sadly many of you do, especially younger people. And speaking of younger people, we've got one of them in the studio today. She's been here before, and we always get a lot of kind comments. And she's very busy, so I appreciate the fact she takes time to answer these questions. There's a lot of them. Roxy Butner, Happy New Year. Good to see you. Always enjoy our time together. So let's just jump right in. We got a number of pretty good questions here. What do we got?
We do. So let's see here. I thought that the first one we do might kind of tie to the idea of ETFs versus mutual funds. So this is from Michael in Poulsbo, Washington. And he says, every year I am gifted shares of AIVSX from a parent who inherited the shares from my grandparent. I currently have 61,000 of AIVSX in my brokerage account. Ideally, I would like to exchange these funds for more reasonable expense ratios such as VT, AVUV, etc. This is money that I plan to invest for the long term. I'm in my late 40s. And I am in the 35% tax bracket. Currently, I donate shares of AIVSX to my favorite charities annually rather than donating cash, but otherwise, I have left them alone since receiving the gifts. I think if I exchange the AIVSX shares all at once for my preferred funds, it would not bump me up to the next tax bracket. Is it reasonable to exchange these shares now or gradually over time, or just let them be?
Yeah, so the AIVSX is the American Funds Investment Company of America. Very well-known, actively managed, kind of expensive fund. The expense ratio 0.56. Also, to buy this fund, it has a load of 5.75. This is not the kind of thing we would recommend if you're going out to buy a fund that you do. And it's really mainly large U.S. companies, kind of a blend between growth and value. And it's a bit of a dividend payer, right? They're betting on stocks that are paying out a healthy dividend, so you're participating in the profits. So you're right. This is not the kind of fund we think you should own. The question at hand is how much he has in this. He doesn't say that, right? It doesn't really spell out how much he's trying to move from this fund to a VT or an AVUV, correct?
Well, he does have $61,000.
Okay, that's right. So, yeah, so this is all exposed to whatever capital gains may be. I guess I was looking for that number, too, how much actual gain is involved. Yeah, so I probably, if I was in the 35% bracket, I probably would look at the tax ramifications of doing this on an annual basis, moving some of that over. He says it's not going to bump into the next bracket, but you can still look at it in terms of how much tax you have to pay to get this done. I don't know that I'd be in a huge hurry because it's not imperative, but it's not a fund that I would use. But what's your take?
Yeah, absolutely. I mean, the big question is, do you need it? If not, then donating it to the donor advised fund, which it sounds like what you're doing, is actually a great idea because it can help you itemize each year, potentially, depending on what your other deductions are, and help with your taxes. Now, that being said, if you do not want to donate all of it and you do want to sell it, there's a lot of reasons why it makes sense to do that. And whether you do that, in 1 year or over a few years, we'll kind of get to that. But one thing I want to mention, just because we were talking about all the money going into ETFs recently, one of the big reasons why people are moving out of these types of mutual funds, not only do they pay out, about 1% a year in dividends, which you'll pay taxes on, but they also pay out about $5 to $6 per share in capital gain fund distributions.
So which is crummy because you can own exchange traded funds now that don't have that issue
at all. So it is not a tax efficient vehicle. So when we always talk about why ETFs are, tax efficient, it's because they avoid that sort of income. So that being said, you're in a very high tax bracket. And so you're looking at probably paying 15 or maybe 20%, depending on where you land in terms of income, of long-term capital gains. And it's hard to say because we don't know what your realized gains are, as Tom mentioned. But I would probably look at, either just doing it all in 1 year, if you're in that 15%, you want to pay the taxes and be done with it, or just over the next few years.
I think that's really good advice. Again, not a fund that we would sign up for. And there's some very fine exchange-traded funds operated by certainly Vanguard if you wanted to own that particular asset class. But you can own, one fund now that takes in the whole world and has a small value tilt. So really good advice. All right. That one came in from the Northwest, I think, correct?
Yeah, Poulsbo, Washington.
All right. What else we got?
Another one from the Northwest. We've got David from Kenmore, Washington. And David asks, normally has about $180,000 of annual income. Took a sabbatical in 2025, but still received a little under $10,000 of income from various sources. Single filer, has a taxable account with various funds of about $500,000 in capital gains. Will resume receiving normal income in 2026. Should I sell all funds in taxable account and then turn around and buy right back? Wouldn't that reset my tax basis to the now higher amount? Wouldn't I have no tax exposure due to low income? So we're a little late getting back to this question, but I think it's a great question.
So in other words, selling it all, booking the gain, which is $500,000. That's not an insignificant capital gain. And I believe, and you can correct me here, for a single filer, you only get up to about, $50,000 in tax-free capital gains where you don't have to pay anything. But after that, it could be a little spendy, right?
Yeah. So, and if he had, so like in 2025, he wanted to do this and he had the $10,000 of income from other sources, really only $39,000 of that first
So the ship has sailed, though, because we're here in 2026. Exactly. And if he's going to make 180 again this year, as he had prior, that's going to be a tough strategy to employ.
Yes. But if he has another situation in the future where he's looking at this, maybe another sabbatical year, then he should look at, okay, just because you don't have any other taxable income from wages or whatever it might be, your capital gains still do count towards ordinary income. So that's important to remember. So if you have $500,000 in ordinary income, that's what determines your long-term capital gains tax bracket. So you'll pay, like you said, Tom, 0% on the first $40,000, let's say, but then you will still pay 15% on the rest, the $460,000 or whatever it will be. So that's
wouldn't you pay even more than that at a certain income bracket? Because there's the surcharge, I think, once you get higher.
Yes. Yeah, exactly. So it's not just, I've had this question a lot where people think, oh, I won't have any income, so I can take as much as I want in capital gains. It's not the case. They still look at your capital gains
as income.
Exactly, for your ordinary income.
Yeah,
Yep.
Great answer. So, I mean, this is another thing to consider, by the way. Anytime you're going to make a move like this, run it a few times. And if it was my money, I'd get a second opinion because I talked probably to a tax professional. That's a rather significant tax bill. And maybe you can ameliorate that over a few years so you don't have to deal with it all in one big hit.
And, what is the point of doing it? Are you in a risky portfolio? Are you trying to get out of individual stocks? You have to kind of weigh the pros and cons.
Yeah, and there's other things to do with individual stocks, right? Or there's other products that might help you there as well. Lots of great questions we get from you by going to talkingrealmoney.com and click on Contact Us. We love to take them. Dawn answers every Friday the verbal questions. Easy to do. You push a little button there, and it's a microphone on your computer. You can also send them to us. That's what these are. We've gotten a lot kind of over the new year, and we're trying to get to as many as we can. Roxy Butner very kindly joining us to do that. And what is next from the mailbox?
All right. This is from Beaverton, Oregon. We've got Dan asking or saying, Dear Tom and Dawn, love you guys and your podcast. I would like to get your sanity check on the following as a long-term buy and hold portfolio mix for the equity portion. We've got VOO at 45%, AVLV at 12.5%, AVUV at 12.5%, VXUS at 17.5%, AVDS at 12.5%. So this should give us a mix between U.S. international, about 70% U.S., 30% international, as well as large to small, 75% large, 25% to small, and a tilt towards value. Would your answer vary depending on account type, whether it's Roth, traditional IRA, brokerage? And finally, what are your thoughts on possible reallocating the 12.5% of the holdings from VOO to VUG, Vanguard Growth Index Fund? Thanks for all that you do.
Yeah, let's answer those backwards. First of all, I don't know that I go from VOO, which is the index, the Standard & Poor's 500, to VUG, the Vanguard Growth Index Fund. I don't think I would do that. You're lumping more on top of the things that have already done well. I think we just had a lecture from Apollo Lopescu of Dimensional Funds, and he pointed out that still in the S&P 500, the Mag 7 still make up, I think it's almost 40% of the index. And so if you go into the growth fund, my guess is you're going to be even more exposed to the stocks that have gone up. So I wouldn't make that choice. Then working back to the top here with all these various VOO, of course, the S&P 500, AVLV is U.S. large cap value, AVUV, U.S. small cap value. You've got VXUS, which is international, AVDS, which is international small cap value. It's pretty good. I mean, the thing, I might want to heavy up more on my international exposure because you're 70% in U.S. stocks, 30% international. And last year, international made 30-something%. The U.S. market made, I think, less than 20. So, and that's not going to happen all the time. But I'd want to maybe be a little heavier there. But that's a pretty good portfolio. I mean, my question always, Dan, to people like you is, how much time do you want to spend on this? I mean, because that's just a lot of work. And for those who are going to do it on their own, I might say just buy a one fund solution that takes in all those asset classes. But what's your take on all this?
Yeah, I agree. It is a lot to kind of manage and make sure that you're not overweight in small over time or underweight in international over time. But if you have a Roth or a traditional IRA, super easy to do kind of a one fund solution. I'd probably keep with something like this in the brokerage just so you have more kind of tax flexibility later on. when selling or buying things. But yeah, as Tom mentioned, you're missing a little bit of emerging markets.
Yeah.
Otherwise, it's pretty good.
Yeah. I mean, the other thing you kind of referenced was where to hold various things. I mean, asset location, while it's a very important strategy, no doubt, is really hard for individuals to manage on their own. No offense. It takes a fair amount of like ignoring your portfolio, because at sometimes things are going to be going straight up and other parts of your portfolio are going to be going down. Rebalancing is more difficult, right? Because if you just hold emerging markets in your Roth and they go up like they did last year, 33%, and you have VOO in your IRA and it only goes up 18, I think it was. What do you do? How do you rebalance that? So sometimes it's a pretty hard strategy to use asset location. If you have a very small Roth, I think what you just mentioned, perfect. One fund solution. Brokerage, again, that would be the place to hold stocks. The qualified money like an IRA or 401k, that's the place to hold bonds in a general sense. But asset location is a great strategy. But for many people, I think, Roxy, what I've seen is it's hard for them to pull it off.
Yeah, absolutely. And just, keep track of it over time. It takes some good analysis tools to be able to really see what it's giving you exposure to over time. So
if you have a question, you go to talkingrealmoney.com and click on Contact Us and send in those questions. And we will get to them. I really feel bad about the guy who had the 2025 tax question. But hey, look, maybe, as you said, it gets another sabbatical year. What is a sabbatical anyway? What is that? You mean take time off from work or something? Yeah. Nah, that's silly. Can't believe you do that. That's not going to work. All right, what else we got from the mailbag?
Okay, speaking of behavioral finance, this is a good one. So this is from Hyde Park, Utah, from Matt. And he says, Tom and Don, first and foremost, thank you for the show. After a long day at work, listening to the podcast is a great way to unwind on the way home. I am in my low 50s and on pace to hopefully retire at age 60-ish. I have a basic index fund portfolio of 55% total market US, FSKAX, 25% total market international, FZILX, 10% mid-cap index, FSMDX, and 10% small cap value with AVUV. I plan to start adding bonds at age 55 until I hit 20% bonds by age 60. I don't change my portfolio often at all, but I am often tempted to do so. Intellectually, I think my portfolio is great. However, I do probably too much research on Avantis funds. At the end of the day, most of the possible portfolios will probably return about the same amount. So my question is, what do you recommend to help someone not second guess their portfolio and or make changes to it when their current portfolio is good enough? I know you would recommend more international, but I doubt that will really move the needle all that much at the end of the day. Would you recommend target date funds or a VT or AVGE for someone in this situation? Or just learn to show discipline and stick to the plan even though the desire to tinker is always there? I enjoy researching funds but I could stop if it would protect me from behavioral pitfalls down the road. Thanks, guys, for everything, Matt.
Yeah. The one thing we have a do it at home electrode outfit where the other person pushes a button and it shocks you if you're thinking, that's such a hard question to answer, right? Because how do we all fix our behavior? How do I fix my behavior wanting to eat something at 8:00 at night? Well, something, or working out more, all those that's a really hard question to answer. Some people do it by not looking at their money very much, right? Once a month, once a quarter, whatever it is. Some people have a safety. I have people in my family who call me up and say, I'm thinking of doing this. And I say, have you lost your mind? Don't do that. So sometimes it's that. The portfolio you've designed is pretty good, I got to say. So I'm not too worried about the portfolio. I worry a little bit when people say, I see stuff and I want to change, because I think Avantis has a new fund, AVGV, which is the global equity portfolio on steroids, because it adds in more small and more value. Well, the AVGE already has small value in it, but this tilts it even further. And many times if we mention the stuff, people say, oh, I got to have that in my portfolio now. But you built a pretty good portfolio here. There'd be some things we could argue a little bit about, but I don't know that I'd necessarily change that. I guess the only thing I could really help you on the behavioral part, and I look forward to what Roxy says, is just look at it less. I mean, I think that's what John Bogle from Vanguard used to say is, don't get up every morning and check your balances. I know I don't. I generally only look at my stuff every 6 months. I put it in a spreadsheet, and then I can kind of look and see the progress. It also allows me not to fret about what's gone up and what's gone down. But what is your fix for poor financial behavior?
Yeah. Well, I guess I'd say maybe 3 things. So have a plan first and foremost, and make sure that your portfolio that you've built fits in with that plan. The returns, the average historical returns, and maybe even, below that average, it still works with your plan. Just so you have peace of mind, you're not trying to reach a certain return to make sure that you get that peace of mind or are able to reach your goals. The second thing is avoid the noise as much as you can. And if you do want to keep up with research, just make sure you're doing it from trusted sources. And not all new research means that you need to make a change to your portfolio, right? And then the last thing, which maybe is the most important, which kind of what you mentioned, Tom, is have some guide rails for yourself. So I'm going to check it every 3 months, or I'm going to check it every 6 months. And then decide when you're going to do rebalancing. Do you do that when you're 3% off target? Do you do it when you're 5% off target in terms of your exposure? And when you start adding in bonds, have a real systematic approach to it. So just very disciplined approach to everything that you do when you look at it. That'll help keep you on track.
Systematic, great word. Disciplined, great word. Automatic, great. I mean, all those things, because we know the people are successful. That's what they do. At that said, it's easy for us to say that and then harder for you to do it. But I think those are all great suggestions. And again, you've really done a nice job building this portfolio. There's really great stuff there. So I now hold in my hands the final question of the episode.
You want to read it?
No, you read it.
Okay.
I'm not very good at reading, as you know, so you take that one up.
All right. We've got from Seattle, Washington, Lawrence, and the subject is inherited money investments. He says, my wife will inherit $300,000 soon. We don't need the money for our retirement. We are both 79 years old. What funds would you recommend investing in?
That used to be the number one question, by the way. I just came into blank. What do I do with the money? And of course, you already know this, Roxy. First thing we're going to say, what's the purpose of the money? Do you need it? Is this money that would make your retirement better? Would you do other things you didn't with this amount? I have no idea when you look at the big picture. Is this just a little bit to you? Is this a lot, et cetera, et cetera? So that would be the first one, to try to really sit down and say, what's the purpose of all this? How is this important to me or not important to me? That would be part one. Then I guess the second thing would be to take a risk quiz of some kind, find out your tolerance for volatility. We have a risk quiz at talkingrealmoney.com. You could take that, and that would help lead to, how much exposure you might have to stocks. And I guess the third part of it would be short-term versus long-term. How long until you really need this money? Because that would help you also decide how much in risky things and how much in less risky things. But what's your takeaway here?
Yeah. I mean, they say that they don't need the money for their retirement, apparently. If that is 100% true, then I would really look at the next generation. And basically, you have to decide what's the risk tolerance for the next generation. What age will they need that money in the next 20 years when you pass? If not, will that continue to grow for grandkids? That sort of thing. So you decide on, we're doing, let's say, 80% stock, 20% bonds. I'm guessing this is all going to be taxable money. So in that case, I'd probably avoid a one fund solution.
Yeah, could be tax issue there.
And then you just decide, okay, do I have enough knowledge to do this on my own and sort of build out my own portfolio, or do I want to hire somebody to do it, depending on what your other investments or liquid assets look like? And if you do, regardless, you should do low-cost index-style funds, obviously. And if you are going to do it yourself, some general guidelines are, in a taxable account, one large U.S. fund, one small U.S. fund, one international fund, one emerging markets fund. Try and cover all your bases with a different fund there. So as they grow, you have some tax flexibility if you need to sell it before you pass.
Good advice, all. And I got a question for you. Thank you for answering all these. What are you going to be doing on Saturday, March 7th?
Well, we are going to be hosting RetireMeet.
Oh, okay. I wasn't sure if you were coming this year, so I'm glad to hear that. So
yeah,
I'm
very excited.
I'm going to hold you to that. There's going to be a lot of people there, both in person in Bellevue and virtually. And that includes Paul Merriman and Joe Saul-Sehy from Stacking Benjamins and Christine Benz from Morningstar. And yeah, we'll drag Don McDonald out here. I'm going to show up. And we got people talking about Social Security and Medicare and healthcare, all the stuff you need to know for retirement. And here's the great news. You don't have to come to Bellevue, although I think March in the Northwest, you're pretty much guaranteed, aren't you? 75 degrees, sunshine, palm trees, all that kind of good. No, kidding about that stuff. But the weather, no guarantees. But if you don't want to join us, and we do have people coming from many parts of the United States right now, you can do this virtually. It's available, shockingly. A small donation is all we require for those who are going to do this online. That goes right to a couple of groups that work with financial literacy. So please join us for retirement. What was your highlight the last few years? You've been to a number of these now. What stands out for you with RetireMeet?
We have some really incredible speakers, including oftentimes Apollo, and I always love to sit in and listen to what he has to say because he takes a really good bird's eye view looking at, really how the market's performed over the last year, but also just bigger picture historically. So those. And
a good perspective and a great way to explain it. Yes, that's what you get from the folks at Dimensional who'll be there. Vanguard's going to be there, a whole bunch of people. So yeah, join us. RetireMeet on Saturday, March 7th. Virtually or in person in Bellevue. Tickets available right now at, I think it's just retiremeet.com. Pretty easy to do. I want to say thank you to all of you who've been sending in all the questions, who have been listening. We had another great year for downloads in 2025, and that just continues right into this new year. Roxy, thank you for taking time, because it's not just coming in here and doing this. You spend a lot of time researching and thinking about these things. So I know it comes out of your busy day as an advisor. By the way, if you want to chat with Roxy, just go to talkingrealmoney.com, click on Meet an Advisor and say, I want to talk to Roxy. She still takes people to talk to, so do that. You get a lot of great comments from people. One guy wrote us recently and said, get rid of Don and Tom and just put Roxy on. She's straight up, no more silly jokes. It's a better program. So we're working our way towards that. So thank you, Roxy, for joining us.
Thanks, Tom.
We're going to be here every single day talking real money.
The opinions and views expressed in this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appellate Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appellate Wealth, a fee-only registered investment advisor.
Please see Appellate Wealth's ADV Part 2A on our website for information regarding Appellate's fees and services.
Appellate Capital, LLC, DBA Appellate Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appellate does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.